Hello, folks. Welcome to another episode of the Swing Trader Status Update. It's Justin Nielsen here, and we are coming to you on May 13th, 2025. It's my sister's birthday, so everyone say happy birthday, Anne-Marie. We've got Mike Webster joining us, as he does every month. This is our second Tuesday that we are now doing our Swing Trader Status Update, so thank you very much for joining us. Mike, it's interesting that we had our last session here on April 8th, which was the low pretty much of this market. And a lot of that was sidestepped by the Swing Trader product. Talk a little bit about, because this isn't the first time that's happened, right? Where we've sidestepped a bear market or a crash even. This happened back in COVID times when you were managing things in 2020. Talk a little bit about how that works, how that happens.
Well, first of all, most importantly, happy birthday to your sister. So, and happy belated birthday to you. Everyone should know that Justin is halfway to being 51 and a half at this point over the weekend.
Wait a minute. If it was halfway, that would be, halfway in the year. Okay.
Yeah.
I was told there would be no math.
Yes. So anyways, look, the point of there's advantages and disadvantages with every style of trading. Whether you're on one spectrum, you're like Warren Buffett and just buying something and holding it forever, or you're day trading or anything in between. So with swing trading, when you're doing it our style of swing trading, that is the goal, is to sidestep. It doesn't always happen perfectly, but it's to sidestep those big corrections in the market, and you'll do test buys lots of times, and you just put a toe in and then take it right back out. But it's all about I forgot that we put this together, or you put this together for us. Risk management is the number one thing with swing trading, and that is the point of swing trading. Is there are times where you just sit on your hands, and that's not by accident. That is by design. And then secondarily is performance. And as both of us know, when we were, creating the market school rules along with Charles Harris, is that it's very difficult to get outperformance in the market unless you're using margin by timing the market, unless you are sidestepping those moves down. You've got to be in cash or light in the market as the market is going down, and that's where you get that outperformance. Because otherwise, just buying and holding, that there's a school of thought out there, just buy the spies and hold them forever. There's nothing wrong with that. That is a style of investing, and that's fine. But you are going to have those big drawdowns like in 2000 to 2002, or in 07 to 09, or in the COVID crash, or this. I mean, the NASDAQ was down. What was it down? 26 or 27%?
26.8%.
Yeah, I mean, that's significant in a short period of time. And so stomaching that is very hard financially, and more important, psychologically, because if you get hit really hard like that, then to do the right thing and get back in as the market's turning is really hard, because you have all those scars. But we sidestepped this. We sidestepped it in 2020, and that is the point. Now, it doesn't mean the next bear we're going to sidestep or do it exactly right, but we did this one exactly right. Like, going back in time, I look at the trades that we made, and they weren't all perfect, of course, but given the information we had at the time, I'm very happy with them. There's always things you're like, oh, we could have started off with a higher, a higher or a smaller position size, or gotten out a little earlier or a little later. But in general, typically you look at a bear market and you're thinking all these mistakes you made. But frankly, at least with SwingTrader, I think we did it exactly right. And that has now put us in a position of strength that, we're back slightly on margin at this point, because we have both the mental capital and the physical capital. We never turned negative while the market crashed. I mean, go to a weekly chart, because I think it shows it a little bit better.
Well, and just, real quick, I want to mention that this was February 21st. We were at 0% on this day. So, I mean, again, it's hard to it's hard to get better than that. But yeah, I'll go to the weekly chart on that.
And
And
look at that, and that was a crash. That we all think about crashes like 1929, 1987, or the flash crash, but how much was it down that one bad week before the bottom?
so that was 10% for that week. And I mean, most of that was a single day, really. So
Yeah. I mean,
uh,
that's really a really treacherous market environment, and we sidestep that. So anyone who is following SwingTrader, you sidestep that. You were able to stay. If you're trading in line with what we were doing, you stayed positive, and I'm very proud of that. And I think I'm very proud of our team and what we were able to accomplish. And it's a little bit on the frustrating side because I know that some people don't get that with swing trading you're supposed to be in cash at times or very light with just some little test buys. And we had a lot of people canceling as we were doing exactly the right thing, and it's mind-boggling to me. They were going, wait, there's no trades here. I go in every day and there's no trades. Well, that's by design. Like, it is
yeah,
very hard for
yeah.
us
The
because
old it's a feature, not a bug.
yeah, it's like, no, there's no trades there again today because
Right.
it's stormy outside and you
Mhm.
want to stay inside nice and warm. Now the sun is shining again, and we when we got the follow through day, we had one follow through day. We got in, it failed. We got right back out. We would do the same thing again. And then when we got other follow through days, that worked, we just get getting deeper and deeper. And that's what you're supposed to do. If you get a follow through day and you start going backwards, well, you don't get in deeper. But as you're starting to make progress or at least going sideways, you incrementally either increase your exposure, your percent invested, or the risk that you're taking, which they're not always the same thing. Now we'll talk about it in a few minutes, but we're a couple days away from a power trend, unless we crash over the next couple days, which anything is always possible. But unless that happens, where we come all the way down into our 21 day, between now and Thursday, on Thursday, a power trend is going to start. And that's not a signal in itself, but it's a mindset and it's a shift with the market where you press it harder, and that's where you make the bulk of your money. So we're really in a perfect position because we're up solidly on the year. We didn't have a drawdown really hardly at all, and now we're going to just be very picky. Doesn't mean that we're going to be reckless. We're still being very methodical and picking our spots, and we're going to miss things that carry too much risk, and just be very very methodical. But as we start making more progress, we're going to get deeper and deeper. And like I said, we're slightly on margin right now. And I expect if this continues that we'll go deeper, on margin. Of course, we're going to have shakeouts along the way. And so we'll have to reduce and live in the moment. But, I think everyone needs to change their mindset, because now we're back above the 200 day, which is that
Yeah.
black line there. When you're underneath it, man, you need to be defensive. You can't be swinging for the fences underneath there. You just have to be methodical, follow your rules, whatever those are, whether there's orthodox position trading or what we're doing here with this product, swing trading. So I said
Yeah.
a lot. What are your thoughts, Justin?
Well, so I just want to kind of point out some of the things that you were talking about, because it was coming rapid fire. So when you were talking about in March how we did have this potential follow through day like action, and so yeah, we ramped up, right? Because that's what you're supposed to do. We were all the way up at 80% right here, but then right back out when things weren't working, and then we had a lot of kind of after things get this bad as they did, as you said, 26.8%, you kind of need, you know, some things to get off your checklist, right? You've shared on the SMT video your checklist, with as much volatility as we had, and just to kind of give you a reference point, the S&P 500, its ATR, its 21-day ATR, is normally, at the beginning of the year, it was around
What's an
1%.
ATR?
Yeah, so ATR being the average true range. So how much does it move from its high to its low? And using the true range, it means in the case of a gap, you're going to use the previous day's close. So, um, you know, in the beginning of the year, and at some point it was actually below 1%. ATR for SPY. Now, after this volatility in here, you had the ATR spike up to 3. A 3 ATR, over a 3 ATR. That's big. That's if that's what your SPY is doing. Imagine what your individual stocks are doing. So that's why we kind of talk about the hibernation as being the best the best case scenario. And we say hibernate, but the truth is we're not really asleep, right? It's
Oh
not like
no.
you're dead. You're screening every single day, looking
All
for
day long, like
anything.
all day long.
I mean,
Yeah.
every single one of those days where it was 0%, it was like, I can't find anything. And that's telling you something. But beyond that, we really were kind of looking at, we had this huge move, 12% up in a single day on the NASDAQ. And even though we got the kind of follow through here, we were looking at, okay, we still aren't up above this level. So we wanted that to happen, even though we got this follow through day. We finally got there. And then it was like, okay, we're above the 21 day. You were asking for 3 days above the 21 day. Well, we didn't get that until right here. And then we touched, we didn't get the low above it on this day. It touched. That was actually kind of constructive action. It was like, oh, well, that's good. Followed by a move above the 50-day moving average line. So that was one more checklist off. And then we kind of had this congestion here. We had this high from March 25th. And we were kind of pausing right there. So there was a lot of concern. And especially, on this day, you purposely, reduced risk a little bit going into the weekend where a lot of, potential market moving headlines could take place. We didn't know which way it was going to go, but it was positive. And so that really kind of changed because it kind of got this final level of, okay, now we're above that March 25th high. We're above the 200-day moving average line. The 200-day moving average line is now in an uptrend. The 50-day moving average line is now in an uptrend. There's a lot that's very different about this market than even a week ago, really.
Well, oh, I love everything you said. You said it exactly right, as you always do. And, one thing to just emphasize is, going into the weekend of how we reduced some going, on Friday. And I would, even though you gapped up, you always have to do a post analysis. And back in 2020, at the end of the day, you and I would always do a post analysis. What did we do right? What did we do wrong? What would we do differently? And I think that's something that everyone should do. And we just kind of do it informally now, but we used to do that a little bit more on a formal basis and discuss it. But when you look at that, you go, okay, given the same information, let's go back to that day. Let's go back to Friday, if you don't mind. And when you're there and you're going into this talk over the weekend, we could have gapped down as much as we gapped up, or even more so, with that news. And we could have come into the 21 day and tested it. And that would have been a long way down. How far above the 21 day were we on Friday?
So let's see. At the close, we were about 3% above a 21 day.
Yeah, and that was certainly in the card. So it was tough having as much exposure as we did into that risk event because we didn't want to go negative on the year. We were able to survive a bear market. I mean, it is very rare for an active trader to survive a real bear, 27% bear, and be up on the year. Like that just does not happen. And so we didn't want to screw that up. So what we did is we backed away a little bit and we sold some things, and then some things that gapped up. And we had on Monday, and we had a few things that were more defensive, kind of rather than shorting. We had GDX on there that didn't work, that we had to cut loose because it was kind of this thing that if the market had fallen apart, it should have gone up. So it was a pseudo hedge on there, and we would do the same thing again, frankly, because it was set up to move up if the news would have been different. But it came in, and so we cut it right away. And whatever's not working, in a situation like that, you just have to be fluid, not plant your flag down, and we just cut it, and we do the same thing again. So the takeaway there is, for people who are watching, do a post analysis every day and be intellectually honest. A good trade is not a trade that you made money, and a bad trade is not a trade that you lost money. It is, did you do the right thing following your rules for whatever you're trading, whether you're swing trading, position trading, or hybrid trading. So, and we mess up all the time, but we just try to learn from it and adjust as quickly as possible. So with that said, that's the history. Now what we're looking at, let's go back to the NASDAQ and look at where we're at right now. We're sticking straight up in the air, right? Where's our line in the sand? Our line in the sand become the low of prior days of just being aware that, okay, you could take those out. Do you have to take much action? No, not really. But the low of yesterday, if we come down there, then you have to start backing away. Not in a huge way, just depends on how it gets down there. But certainly that 200-day, that is what I'm focused on. As long as we can stay above that, and my rule is, you get above a moving average, you get a close above the moving average, that's step one. Get your low above it and close up on the day, that's step two. Then having 3 consecutive days with your low above it and closing up on the day, that really tells me that you've gone through that moving average. So that would be tomorrow. As long as we can hold above the 200-day tomorrow and close up, I would say, okay, we have now passed that test of the 200-day. And we're just going to shift our mindset. At some point, we should talk about that 98, 99 time frame.
Let's do it right now.
Okay, yeah, perfect.
I'll move over.
Yeah, why don't you walk through that, and I'll just add my 2 cents.
Okay, so this is something that we kind of created to show how we were looking at this this time period. So we have this 1998 precedent that we were using, and there was a lot that was very similar. So the way we were looking at it was kind of in a cautious way, right? So if you said, okay, here's your top in 98, okay, you come down pretty sharply at point B here, so kind of matches. The difference here is in 98, you did get support at the 200-day moving average line, but I will also say that the volatility during 98 was way up there, during that time, late 90s, very, very high volatility. So you got this move up to C, and for 98, you were up to the 50-day moving average line. In this case, for us, it was the 200-day moving average line in the current market. And then you got this move, down to D, where this is where we were at, and we were thinking, okay, it's quite possible that going into the weekend, we were at this point E where we could be looking at another leg down. That was very, very reasonable. And just for comparative purposes, this point in D in 1998, you already mentioned that we were down 26.8% from our high. Here it was 27.2. That's pretty close.
That's pretty close.
But
yeah.
But when we came up here in 98 and then dropped down again, we were down 33% off the high. There's a lot of damage that can be done. And so hence the reason for a little bit of caution going into the weekend, this past weekend. Because again, if we had gotten too heavy along the way here and rode this thing all the way down, that would have been no good. But well, let's kind of look at how things played out. And you know what? I thought I moved this because we were kind of looking at this and it was maybe a little bit too confusing. But, if you kind of move this C over here, if you move point E over here, if you move point B over here, if you move point D over here, if you kind of shifted everything and you said, oh, well, if this is really our D is as bad as it got, if we already had this leg down, if this was our first leg down and this was our second leg down, and that was it, and now we're back above the 200-day moving average line like we got on Monday, well, that's a whole different situation. And this is what happened in 1998. after. Now, remember, we had the Asian contagion currency issue going on. We had the Russian ruble default. We had, long-term capital management needing a bailout. All of that stuff was going on during here. And once it was resolved, it was off to the races in a big way. And you had some really great leaders, Charles Schwab, AOL, both of which made 400% in 6 months, from the follow through day here in October '98. So everything looks different now when you kind of put that lens on. The fact that we got above the 200-day moving average line really does change our outlook. And so, as opposed to being a little bit more tentative last week on Friday, now it's kind of on margin. It's game on.
Yeah, I think people should go back and re-listen to that and study these charts, because it's a great illustration of when the facts change, we have to change, and that's something we learned from Bill, as well as all the great traders out there. Is you act with the information that you have, and then when it changes, you have to change. In the gap that we had yesterday, that changed everything, because it just told you that this big risk, at least the way the market was interpreting the risk, is now changed in a huge way, enough that that it built on it today. So I'm sure a lot of this is a short squeeze, and the shorts will have their day again in the sun again, and we'll have some kind of nasty days, and that's to be expected. And that's not fun, especially from a swing trading standpoint, because with risk management being number one, you got to back away and then you got to get back in, and that's a lot of activity and can be tricky. But really, yesterday and today, that's a game changer, and you have to shift your mindset completely, just like we shifted our mindset when we got the initial follow through day, even though there were problems with it. It wasn't perfect, and then we had a subsequent follow through day the very next day, and then got above the 21 day and all the things in my checklist to get through. We're just going through that checklist one by one and ticking them off so much faster than what is normal. And the only thing that it reminds me of really is the COVID bottom, where when we were looking at COVID, let's switch over and look at that, because again, we were looking at 1998 and thinking that, okay, it was going to come back down again. This is in 2020, the February 2020 timeframe. And when you came up to that 200 day, that was when you gapped above it. That was kind of a game changer. Now you notice, like a week later, you get that nasty move back down through your 200 day, closing at the lows. Something like that could be in the cards, and if that happens, we'll have to back away, and then we'll have to adjust. That's what you do with the swing trading hat on. Now, if you get a position trading hat on where you're letting things wiggle and wobble more, then that's different. Maybe you wait for it to cross below the 21 day and close below it before you start taking action. So you don't, you can do a hybrid. In my personal account, I do a hybrid of swing trading and position trading. And if swing trading is working better, I do more of that. And if position trading is doing better, I do more of that. And we're doing that with SwingTrader now too. Well, we will be totally open to doing it more from a position trades now that we have these chips to spend, because I always equate trading a portfolio to just like poker, and if you're in a poker tournament and you've got a bunch of chips, you can play a certain way. You're short stacked, you have to play differently, and there's going to be times where you're going to be both or somewhere in between. And so that's what we're now in a position of having a pretty decent stack because of how we've done this year. And not just the difference between our performance and where the market is, because the market's come back a lot from the bottom. And we knew that we were going to be giving up a lot of that difference between where we were at and where the market was at. We would do that again, because what we wanted to do is that risk management that we talked about, of keeping that drawdown very, very small. So could you walk through this chart for people that maybe have never seen it before?
So actually, this is from 2020. So
okay.
since we were talking about that, I just kind of wanted to show
I was
what
like,
we
wow, I
did.
don't remember us being that deep in the market.
Right. Yeah. We haven't gotten here yet.
Yeah.
This is the future. But
Yeah.
to your point, again, we really had, come down considerably before things got really ugly. It was, and this was just something where we were selling into strength in February. If I remember correctly, our last position was like GDX
Yeah.
at the time, and we were at zero when all of this destruction happened. And we had a couple, attempts, a few tries, but quickly backed away. And then, of course, we got the follow through day on April 2nd for the S&P 500, April 6th for the NASDAQ, and that's where we started to ramp up. But as you said, hey, there were some wiggles here, and so we came back, reduced our exposure, went a little bit heavier, reduced our exposure, and there was that final shakeout that you pointed out, and we really came in, very, we raised a lot of cash when that happened. But then, once we survived that, we had a little bit more of that, cushion. We were still, because we had stayed positive, for the year, and we had all that cushion, we had this big gap over the S&P 500. We could really put the pedal to the metal, and it was a phenomenal year. If I remember correctly, SwingTrader was up over 80% that year, and it started by staying positive, when the market was down as much as it was. And again, the market was, it was a really tough year to start for the market, but it ended up being a strong year for the market even. But I can't remember if it was a triple or, uh, you know, SwingTrader obliterated it in 2020. So, we can go ahead and take a look at some of these performance metrics right now. Of course, for those of you that have SwingTrader, this is what you see updated every day. And again, you've noticed that we've stayed positive throughout this whole time, but this really doesn't tell the story. It's like, oh, that's great. You're up 11% versus, the S&P 500 that just got back to positive today. But this really kind of tells a little bit more of that story. And just as a reminder, this is our SwingTrader performance, the purple line. We have a 10-day and a 21-day moving average on our SwingTrader performance to kind of say, okay, we're making progress. We can gun it a little bit more. And of course, this is the S&P 500. This is a year to date, just to kind of show the whole thing rather than our typical 50-day rolling period. And again, you can see how light we got. Here's that March, 24th follow through day, and in follow up, we were ramping up, but then quickly backed away and had a lot of cash for a lot of this period. So again, I really appreciate the comments coming in from YouTube where there's some of you that were with us and you're like, yeah, that told me what I needed to know. Unfortunately, there were a lot of people that didn't get it, and they're like, oh, this product is broken. It's not doing anything. And
I don't mean to laugh, but when I heard from our marketing folks we had so many cancellations, my brain has been spinning ever since, because I'm like, wait, we avoided a crash, because I always wanted to be like Bill O'Neill, the founder of IBD, and he avoided the 87 crash. And you always want to have that on your, and he had Zweig, also avoided it too. And I'm like, okay, well, we avoided the 2020 crash. We avoided the 2025 crash, and people are canceling. What is going on with this world? It's like upside down. It's like a world where people think the Beatles are better than Led Zeppelin. Like, it just makes no sense. Or like
well,
David
and you know what?
I
will say you had taken a break from IBD, but in 2022, unfortunately, we didn't end up positive. And it was like at the end of the year, fractionally down in 2022. But that was a big bear market, a persistent bear market.
You guys did a great job. I'm very proud of you and Chris and Dominic, doing that while I was away. And that's the benefit of this product. Now, would I be happier if our returns were a lot higher? Yes, but to take that, to get those returns, like we might do in our personal accounts, you've got to take on more risk. And so we're trying to do this. We're being very, very conscious. I take SwingTrader more seriously than I take my own trading, like from a risk management standpoint, always looking at it saying, what's the right amount of risk for us to take for this product, and how do we determine that? By this chart that you build every day, your equity curve versus your moving averages. So there's two things. One, you look at isolation of how you are doing versus yourself, right? And so that's why we have those moving averages. If you're above your moving averages, those are the chips that you have to spend. So this is what I would suggest everyone watching, whether you take SwingTrader or you don't, for your own account, build this in there. Just your account value. If you put money in or take money out, you've got to do some adjustments, and just Google how to do that. But assuming that you don't put money flows in, put some moving averages on there. We like to use a 10 and a 21 day. You could also put a 5-day. You could put a 50-day. You know, you could. We just don't want to make. We didn't want to make this too cluttered. And then the distance you have from your equity curve, your account value versus your own moving average, those are the chips that you have to spend. That's the risk that you have to spend. When you come back down through them, then you've got to go like a turtle, right? And you've got to go back in your shell and say, okay, what did I do wrong? Was it me? Was it the position size? Was it the stock? Was it the entry? Was it the exit? Was it all of the above? Is it just the general market is turned? Is the swing trading out of fashion for that phase? You have to do that post analysis that we were talking about, and then see. And then what we like to do is flatline it, like we did there.
Mm-hmm.
When you go through it, just think of that. If you're just using your 10-day moving average of your equity curve, if you're in cash for 10 days, that'll catch up, right? By definition. And it's a technique that I used to use back in the 90s. I did that over a 5 to 9 day frame time frame, but just pulled that tool out of the toolbox for SwingTrader. And that's how we do it, and that's how I would suggest people do it. And that's how much gas pedal you put down or how much brake you have to put on. And you can see at the bottom, the green is how deep in the market we're in. And that doesn't tell the full story, because if we've got 10% in the Qs versus 10% in the QLDs, which is a double, or 10% in the TQQ, which is a triple, it doesn't really give you that same visual. So that's why we use something else. And do we have the ATR
You know
portfolio
what?
stuff, or are we going to do
Get,
that
get,
next month?
no, you know what? Give me a second. I can add it. Yeah.
Okay. So while you're adding that, I'll just kind of explain it. So this is something that we like to do, where to measure how much volatility the portfolio is taking, we look at the ATR, again, the average true range, on a percentage basis of each one of your positions, and you just do it proportional to the portfolio. So if you've got a cash position in there, that cash position has an ATR of 0. So that helps reduce things a lot. The more cash you have reduces your portfolio ATR. So if you've got, let's say, 100% invested in the spiders right now, and the spiders, the ATR is like 1.95%. Let's call it 2%. Then your ATR for your portfolio is 2%. And if you were to do that with a double, then it's going to be 4%. And so, yeah, why don't you walk through this chart and explain it? You always explain things better than I do.
So you know what? I just have the 50-day, because again, we usually have
That's
a
fine.
50-day rolling period. But this kind of gets the point across. You can see, when we're in cash, of course, what is our ATR? 0, because we're not moving at all. There's no movement. But then you can see where we get a little bit more aggressive. And so now remember, again, putting this in perspective, back here, the SPY was at 1%, roughly 1%, a little bit below at one point. As we got here, SPY was all the way up at 3%. So when we were initially kind of ramping up exposure, we want to be careful, because that's a very large ATR for SPY, S&P 500. And so, we were very slow to kind of, ramp that up. And as you mentioned, we, would sometimes back away, fairly quickly, just to make sure we weren't overdoing it. A lot of times that was happening on weekends. And by the way, that was something we were doing in COVID too.
Mm-hmm.
There were a lot of, in January and February, there were a lot of headlines that were coming out. and we would a lot of times be going going very light going into the weekend, because we just weren't sure what headlines were going to come out. So now, we've got a pretty high ATR. We're over 4%. So that means that our portfolio at this level could move 4% from high to low in a day, and that's aggressive. And look, we're just barely on margin. If we were really heavy on margin, that could be even higher. And so, to your point, right now, some people might be asking, well, why did you go with the Qs instead of TQQ? You would have done so much better if you had gotten the leveraged early on. Yes, but it would have really ramped this ATR percentage up in a much bigger way, maybe more than we were willing to take. It would have caused bigger movements in our equity curve, and we just weren't ready to do that at the time. Did you have anything to add on the ATR? Because I also wanted to make sure we talk about the relative strength.
No, I would just say I would suggest that people do this with their own account. And I think the next time I'm on your great podcast that you do, we'll probably talk about how to do this in a little bit more detail. So probably in June or July, I'll be on there with you, and we'll walk through how to do a portfolio ATR in some more detail. But it's pretty simple. You just take it on a proportional. This is 10% of your account. That's what the ATR is, and then you just run through the math, and you add it up, and be aware of how much risk you're taking. And again, given the same situation underneath the 200-day, I would still go with the Qs instead of the TQQ or the QLD. Now that we're above the 200-day, when it comes time to get, let's say we exit our Q position or our SPY position, and we want to go back in, we'll probably go with a double or a triple at that point. But right now, at that point, it did not make sense. It was too much risk, given the information that we had at the time.
And so here's our relative strength line. So we do like to calculate. And look, the relative strength line, we have it on all of our market search charts. The reality is it's not proprietary. It's just a ratio of the performance of the S&P 500 versus the whatever you're comparing it against. So you can see how our relative strength was doing very well. And when we were on last time, it was right here, and Mike was making the point, look, it doesn't get better than this. In terms of our relative performance. Everyone might be looking at this, well, you're only up like 4% for the year, 5% for the year, but relative performance wise, it's hard to get better than that. And we knew that, look, if the market rips up, we were going to give up some of that relative performance. But again, this is kind of going back to that precedent of 1998. We had this risk of, okay, if we had another leg down, we could be looking at, and look, we could have still gotten relative outperformance, but if that led to losses, well, then there's our hierarchy. Risk management is number one, performance is number two, relative performance is number three. For a mutual fund, relative performance is number one, because all they have to do is beat the S&P 500 and they say, hey, we won. If you lose money, but you lose less than the S&P 500, they consider that a win. But that's not the way we view things. We're really trying to not lose money. Risk management, again, is our top priority. And so that's why we were okay giving up some of this relative performance versus the S&P 500, because, as you said, we had a lot of chips to play with.
Yeah, and on top of that, and I agree with everything you said, we were underneath the 200-day, and I've done a ton of work on when you're underneath the 200-day, people can go back and just do a change date. And I would suggest, I give that homework out all the time on the SMT videos on Friday that I do with Allie or with you when Allie's away. And it's constantly just go back and study history, like the two of us did with Chuck when we were doing the market school rules, and just study it and study it and study it. And you notice it is completely different when you're underneath the 200-day than above it. Like, there is nothing more meaningful. I've used the 21-day. I've popularized the 21-day exponential. It's at the core of everything that I do. But the 21-day is nothing compared to the 200-day. The 200-day, everyone uses. Not everyone uses the 21-day or the 50-day or the 10-day or you name it, but everyone uses the 200-day. Even people who don't know how to really interpret charts, they're just fundamental folks. They know where the 200-day is. When you're underneath that, completely different game. Now that we're above it, as long as we stay above it, then we're going to be shifting and leaning more towards, the relative performance in a short term, and have that up higher. It's still the last one of those three, like you said, the risk management, performance, and then the relative, but it will become more of a weight. When we were there at the bottom, I said, this is, we talked about it. I said, it's not going to get better than this ever. Like, this is as good as it will. The difference between our performance and that for that early in the year just does not happen unless you're a gunslinger and you're taking on tons of risk. Then you can get crazy stuff. And I've done, we're both can do that in our personal account where you're a gunslinger, but that's not a product that is for everyone, So with this is as good, I'm super proud of our team. I'm super proud of what we've done. Very frustrated that people got that were. I'm like, I want to call them up and go, hello. Like, do you
Mike is going to be in charge
understand?
of the stop save.
Yes. Like, do you understand that we're doing like perfect? Okay. Next.
So one other thing, and you know what, I want to address. There's kind of a conversation going on YouTube right now
Sure.
in terms of because we are on margin right now, right? You can see that the 100, we're a little bit over 100%. And some people are talking about, well, don't you have to wait for something to clear for a day? Look, if you have a cash account, then that is the case, where you do have to wait for something to clear. It's down to a day now. It used to be 3 days, and then they lowered it. What was it, a year ago or something? So the settlement is only a day. But if you have margin, you don't have to wait a day. You can just immediately use those funds. And I use, I do most of my trading in Roth IRAs, which are cash accounts, but you can actually get what's called limited margin on those. And limited margin allows you to use those funds immediately without having to run into the free ride and good faith violations that you would get if you had to wait for that day of settlement. So if you do have a cash account or you're using a Roth IRA, look into that limited margin because it does get you away from that. My 401k, it doesn't have that ability. I can trade individual stocks there, but I can't get limited margin in my Fidelity 401k brokerage link account. And so I have to be very aware of that. So I have to handle those stocks a little bit differently because I have to be aware of my settled cash and I have to move a little bit slower in that account. So I have to make adjustments. But yeah, we're kind of going off the basis that you're using a margin account to follow this. So I just wanted to say that.
Can I add a little something to that? With because I trade margin accounts as well as cash accounts, like you do. My cash accounts are my 401k or my 401k rollover, so an IRA rollover. And with those, if I'm going to trade a QQQ in my margin account, like we've done with SwingTrader, so a single, in that account, so I don't eat up the buying power, I will go with the TQQ. So if it's a 10% position is what I'm targeting, I'll do a 3.3% TQQ. So I have that extra space. But like you said, the limited margin allows you to not have to worry about the settlement. And if any of this is confusing to you and applies to you, call up your broker and have them walk you through it. And what your options are, and every broker is a little different. I trade through IBKR as well as TradeStation, and every broker is a little different.
Yeah. So let's go to this chart real quick. This is our off high chart. So again, you can see starting at the beginning of the year, we were at highs, which means we were at the zero mark. We came off a little bit, but then we were down at most 4% off our high, and we didn't let it get worse than that. As opposed,
it doesn't get. I mean, I don't want to smile so much, but it's like I've never patted my back in my life, and I wouldn't if it wasn't for everyone who was canceling. I'm like, are you kidding me? Like, what do you want? Like, really, what do you want? A 4% drawdown while the market crashes?
Yeah.
I mean, I guess, like, I don't know what else to do, man.
Yeah, do better. So anyway, we're right there. We're back at highs now.
Yeah.
So we're back at highs. Made that, and again, so that 11% that we showed at the beginning, up for the year. Very different from what the S&P 500 is looking at. And again, we're already at our highs. Whereas the S&P 500, hey, look, it made up a lot of ground. It's only 4% off its highs, roughly. So yeah, it made up a lot of ground. Good job. But we avoided again all of that, and that the mental capital, protecting that as well makes a big difference. You know what? Let's talk about some stocks.
Sure.
Because there's a few stocks that we've been looking at, and we want to kind of share our thoughts on that. And I'm going to go back to the present, and let's talk a little bit about Uber. I do have a position in this myself.
Yeah, so do I.
We put this on yesterday, and we had a really great discussion on this because Ali, our lead host for IBD Live, and of course the host of the Stock Market Today video, was talking about how she was buying this herself. And one of the things that she was talking about is like, look, yes, I might be buying it at a basically the same price as it was here, but it's different now because it had this pullback. So now we've got a stop that we could use. We've got something that we can kind of put here. Once it was sticking straight up here, where do you put your stop? Like down here? That's too far away. Do you do it at the the day's low, which we usually use? The fact that it was just sticking up so much was really tough to justify a position entry right there. But once we had that pullback, it was a different story. And so, in addition to that market change, as you said, with the gap up above the 200-day moving average line, it was kind of okay. Things are different now. This was a this was a ad that we felt pretty comfortable doing early in the day.
Yeah, well said. And so when people look at SwingTrader, what I would say is that I would, as an outsider, I go, why did you pick this one and not this one? And so a lot of the answer is almost always the risk that you're taking before you know you're wrong. So we like to keep our stops when at 3 to 4%. Now sometimes they have to be a little bit bigger than that, but 3 to 4% is kind of the sweet spot of how much we want to give up on a particular trade. So with this one, it allowed us to have something close to that with using the low of the day, which would have been a logical place for, if you traded underneath there, it wouldn't have looked the same. And you would have wanted to back away from a position trading standpoint. So more like what the guys do on leaderboard, then you can give it more room. You can give it up to 7, maybe even 7.5% or something at times. But with swing trading, you have to have tighter stops. Now, a different way we could do SwingTrader, but I think it would just drive people crazy, is we put something on and we're down 0.5% or 1%, out it goes. Well, we were doing a lot more alerts earlier on when I came back last year, and it just was too much for people to follow. So there's different styles of swing trading. I try to gravitate. I personally gravitate towards, I buy something, I should be up on it, and it should really only be down a 0.5% or 1% before I know I'm wrong. But for it to be something for folks to follow, we kind of have a 3 or 4% thing. And so that's where that one worked. There were better stocks out there, but there weren't better stocks that we saw with a good logical risk in there. And so, we could just buy anything sticking straight up in the air and just say, okay, if it comes down 3%, we're going to stop ourselves out. That's not a bad style. That's just a different style than how we're choosing. And so that's what a lot of this goes. Yeah, the same thing with the roadblocks is we
Very
had
similar.
we had a low to trade against.
And I do have
And
a position in Roblox as well.
oh,
So
I do too.
we
Yeah.
have to disclose that.
And so, do I think this is the best thing out there since sliced bread? No, it's okay. But on a risk basis, it made sense. And so that's a lot of times of what you're trading is it's all about the risk. How much risk are you taking before you know that you're wrong? And you should look at every chart that way, whether you're swing trading, position trading, anything in between. Know how much risk until you know that you're wrong, and adjust everything accordingly. Your position size, what other stocks you're doing, and everything. And this looks okay. Like I said, I wouldn't put 100% of my account into it. It's not that type of a stock.
One last thing, as we typically do, we'll just kind of give you a preview for those that aren't on SwingTrader. For those of you that are on SwingTrader, the product you kind of know already. You see what the individual stocks that we have are. We have a lot of ETF exposure. We've got some sector ETFs as well. In addition to individual stocks in some of these different areas, but we're starting to spread out. Again, there's no cash component. For the longest time, it was one big dot of cash, and now we have just a slight margin. And so again, this is one of the things about we can always on these monthly calls kind of talk about what we're seeing, what we think is going to happen, but we at the end of the day have to change with the market, and that means having that flexibility. Mike Webster was just on Joe Fahmy's podcast talking about Bill's flexibility and
Did you
how
watch that yet? You haven't
I
watched
did.
it.
You
Oh,
know
you
what? No,
did.
how do you think I knew about the flexibility? Because
Well,
I
I
was
thought
listening.
you would just assume that I was
Right
talking
now,
about.
I was listening to it. I was listening to it in the car on the way
Okay.
into work today. So,
Okay.
yeah, the one thing about not coming to the office as often is that I
Wait,
don't
there goes
listen.
Eagle Eyes right
Yep,
behind you.
yep. There's
Have Eagle Eyes and Chris just at least wave,
yeah.
acknowledge that we're here.
Mike wants you both to wave. So, so,
Well, I see
um,
Russ is back there too. Russ needs
yeah,
a wave too.
yeah. Well, they're
Okay.
in the middle of a conversation. So,
Okay.
but yeah. Anyway,
Joe
while
Fahmy.
we try and tell people again what we're seeing in the market, it can change like it did yesterday, and that flexibility, it's hard for us to do on a monthly thing. That's where the product comes in, to have that ability to communicate with our subscribers. Oh, here's a change. And then one of the ways, of course, that we're communicating is by the number of trades, how much you're seeing the activity change. And at the end of each day, we do that percentage invested. Just so you know, sometimes you have to hit F5 to refresh it, but we give you that percentage invested to kind of give you a sense of where we're seeing things at the close of each day. So very valuable information there. So hope
Well, one
people
thing
take
I
advantage of that.
would I would say is that, yeah, with the product, whenever you go onto it, until we have some technical issues, hit the F5 button on your keyboard just to refresh anything on there. And I'm having to do that. We're aware of it, and they're working as hard as they can on that. And the second thing is, I would watch Joe's. It's called Joe's Happy Hour. It's on YouTube and Spotify. Not just the episode I was just on, which was a ton of fun. Joe puts out a really good podcast, and it has a lot of different people on there. I know you're going to be on there in the future. We were, he talked about that. Hopefully, maybe that he talked about both of us going on there
That'd be
together,
fun.
which would be a lot of fun. And yeah, catch that one. And yeah, I liked doing that a lot. And so Joe's Happy Hour on YouTube.
And of course, for those of you that maybe haven't been on SwingTrader, it's certainly worth giving it a try, especially as we are ramping up right now, a lot more activity, and hopefully we can get some outperformance and really have a great close to the year. Any final thoughts? Oh, you know what? One thing I also want to address from YouTube, a lot of people are concerned about, gosh, we're so extended now. That's the fear, right? You look at how far you are off the bottom, and people are afraid. Oh, we're coming into this area right here. We're so far above. Now we were 3% on Friday above the 21-day. Now we're 7.6%. So any thoughts on that, Mike, to kind of close us out?
Yeah, so that To measure that, I developed the Webby RSI, one of my indicators. That measures the low versus your 21-day. And the one thing that I think I talked about it with Ali on Friday's S&T
Yes.
when I go over the Webby RSI, is that it was acting right where you were getting the distance from you were getting a number of days where your low was above the 21-day, but it didn't have that oomph. And I know people use like the different breath thrusts out there, and Zweig breath thrust and other things like that. That's not what I don't use those. But what I use is when you're getting that low versus your 21-day early on in the move, up like it is now, that's a very positive sign. But they are right to be concerned that when you're sticking straight up in the air like that, what would be normal and natural? Well, a little back and fill.
Yeah.
But with that in mind, go back to 1999. Just do like like January 1st of 99 or thereabouts. During that whole move up, and there was a bad tick in there where it came down to that's a bad price, but anyone who was waiting for that pullback, you never got it. It was just inching up. And the two of us have studied so many markets. I think it was the 78, 79. We don't have to go there. 78, 79 market where it just kept running up and running up. And I remember when we were working with Charles Harris on that, he was saying, wow, man, that's something that he was sold into strength and been very hard to get back because it was extended. And just kept getting extended. So that is part of how the market works to frustrate most people. So that's why I'm glad that we're in the market, deep. We're fully invested with a slight amount of margin, but we're not in there with crazy positions. Like we don't have triple leveraged and being that deep in. We don't have wild and crazy stocks in there. We have a good stop on every one of our stocks. But would I be surprised if, for the next week we had some chop or some give backs? No, but you trade the market that you have in front of you, not the one that you want or the one you're afraid of. And right now, everything is acting very powerfully. We've got that distance there, which was one of the last things we had. The power trend, we'll probably talk about that on IBD Live tomorrow. About the basics on that, your low versus your 21-day, you want that to happen for 10 days. You want your 21-day to go to be above a rising 50-day for 5 days or more. That's the essence of it. And then that's what a power trend is. And that's something that the two of us came up with Chuck. And it's probably one of the best things collectively that I think that we've done. And it's really meaningful. It's not a buy signal, but it is a mind shift that you lean aggressive while you're still above your 21-day. We close below the 21-day, man, I'm going to be heading for the hills, and that's a long way down. So hopefully that
200-day, that'll be kind of your first sign, So
Yeah.
again, the 20, you don't have to wait until the 21-day before you do anything. There's going to be some signs there, and again, you'll see us act accordingly. So that's going to wrap it up for us this month. We will see you all on the second Tuesday of June. Take care, everybody, and good luck trading in the market. We'll see you next time. Bye-bye now.